And as you follow along, whether you take our suggested pattern in play or not, you're learning what the thought process, the technical process behind it is. So let's talk about this is black gold. Let's talk about what might be happening here in the yellow stuff. So, in fact, our guest today is Christopher Aaron, and he's a gold analyst. So we're going to have a chance to talk to Chris about his view. Many people bearish. Looks like it's trying to carve out some type of bottom here in the gold. Right here, we're beginning to diverge. Actually looking for maybe one more capitulation to the downside, shake out people under the big round number of 1,200. I think that what goes hand in hand with that is going to be one more nice push up in the Dixie. Take out the 95.65 high up here, having a decent day here. And Euro, Grega bearish, looking for lower numbers. To me, it looks like we at least take out this bottom here, clean out the shorts. We'll see if we confirm the lows or not. What tells me that is markets rarely bottom when price and momentum confirms price. So we had a new low here. We had a confirmed low here in the RSI. We may not confirm the next low when we take this out. I'm assuming it's going to happen. So probably a tight risk trade. Probably want to get out of the way back over 1640. Some of these recent highs, it's still respecting the triangle breakdown. It tested it here. It tested it here. This may be enough before we accelerate to the downside and make new lows for this decline that's been going on for quite some time in the euro. As you can see from the 125 level, this was, if you really want to be bearish, a continuation formation that could take you, down to 110 or so down the road. So that's the look in the dollar. Stock indexes, the Dow, Blake pointed out yesterday, when you look at the weekly chart, well, here's the daily. Look how the Dow is struggling, even though every time a stock starts to perform poorly, they replace it with a stock that's been performing better. We were just above 61.8 back from the February crash that we had. So it's taken all this time just to retrace 61.8, where you have some of the other averages threatening new highs. That would be the S&P. We're not that far away from it. Most people are assuming it's a layup, that there should be no problem getting there. Just want to point out that even with the strength in the S&P at new highs here, this was a confirmed high. We're diverging here on the 4 hour. Even if we made a new high, we'd be diverging on the 4 hour. The 1 hour had another confirmation. Same scenario with NASDAQ. We've been making new highs. Yesterday's surge to new highs, as you could tell, was not confirmed. NASDAQ was a weak sister, but that too only a stone's throw away from new highs. This happened before the Facebook debacle, where the market defriended it. Pretty surprising. We've had an 88.6% retrace of that move. So we'll see if we can eke out a new high. Even if we do, it's not going to be confirmed in the NASDAQ. It's hard for me, and let me coach you. Anytime you look at a market and say, for example, you were short here and, you're thinking about getting out because you're under some pressure. I am personally. I always ask myself, well, would I reverse here? Would I buy this market here if I'm bearish? And the answer is no. Even if it made a new high, that would be more of a sale to me than that I'm looking for a big continuation move to the upside. So you could do that the same way with every market, and it'll help you stay in trades longer, which is one of my weaknesses, is staying till objectives. That's why another method is take partial profits and leave a piece on. But look at your positions sometimes when you're starting to question it, even when it's going your way, and say, for example, if you're short and you're looking at the market, say is the market in a position where I would reverse out and get long? And if the answer is no, walk away. Hey, boss, if euros go lower, we've already been killed. I still, the technicals in the pound are still not great, way overdue for rally. The guppy is rallying a little bit. We are starting to diverge here. We're at some pretty important levels on the weekly. So it'd be hard for me to short it here. So I hope that helps you. But the technicals on the shorter term level, what I would wait for, and you started to get that here yesterday. You see on this break we had early in the week, this is your 1 hour chart. Both price and momentum was confirmed. And then we had another new low, looks like maybe by a pip, 28.51. Yeah, 28.53. So this was a new low and it didn't confirm and then moved sideways. And then we had one more spike. And this was your second non-confirmation on the daily. So at least technically, or momentum-wise, momentum, what this is saying is momentum at each new low is losing downside selling pressure momentum because momentum's not confirming it. This looks like a pretty important level. I think Blake was talking about this yesterday. This was kind of a breakdown. So if we get back above this high, it would really look constructive. Hope that helps. Angelo? So we have a great guest ahead, and again, want to welcome all our viewers from investing.com. Again, you may want to consider becoming a member, and also what faces here for an hour and a half, an hour of analysis, half an hour interview, but we also have a private member chat. And all the guys, Blake, Steve, Stell, plus the great traders, and plus we have Amanda, who is a moderator, and Joe helping out in there. So you can banter and share ideas and collaborate for many hours after this free webinar sponsored by Forest Park FX is over in, let's say, the next 80 minutes. So the markets continue, even though face ends for the day. And we hope you're enjoying our free webinars. Our mission is to build up and edify traders every day. And that's what we're trying to do. Amanda does. She runs the chat, takes care of her daughter, and makes her living from the market. So as you notice, Nitish, and I think you're another one, that it's not just people that are learning, or it's an avocation. There are many people in there that put bread and butter on the table, keep a roof over their family by pulling equity out of the market. So besides having one of the best free or paid webinars on the net, the private chat, 100 people, well over 100 people at times, is going to keep you straight. And you know what? As traders, we all only have two eyes. So working with people, I teach, surround yourself by people, by traders better than you, and you'll rise to that level. And other people may see things you weren't even considering and bring your attention to it. And it could be compelling enough, and you would have missed it without the collaboration. So I'm a big believer in having a community. It's kind of like a mastermind. That's what all the S people used to talk about, having a mastermind, when you have a group of people sharing ideas, cooperating, supporting each other. It exponentially increases, I would say, the effectiveness of what you're attempting to do as a trader. So with that being said, I'm going to turn it over to my colleague, Blake Morrow. Everyone knows Blake, and Blake is really, this was his dream a few years ago, And it's really been amazing watching ForexAnalytix develop and grow like a mushroom. So Blake, how you doing today, buddy?
Hey, good morning, Dale.
How are you?
I'm good. It's is it Wednesday?
Thursday.
It's Thursday?
Are you happy now? Investing.com Thursday, buddy.
It's Thursday. You know, my kids went back to school yesterday, and I can't tell you the quiet bliss that I have in my home. It's nice. It's been a couple of months since I've had peace and quiet throughout the trading session. You know, I mean, even though I'm in my office, they'll come in and Dad, I'm hungry. Dad, can you do this? Dad, I need to go here. It's like, man, I'm working. It's one of the perils of working at home versus being, on the East Coast and going into the office in Connecticut is, you get but the flip side is, as I roll out of bed, I'm, it's a.
You like your commute.
Yeah, my commute's great. It's awesome. I don't have to take the train in every day. It's awesome.
And which bathrobe to wear today?
Bathrobe. Shoot. I live in Phoenix. It's what pair of underwear I'm wearing today. Anyway, so it's been, first of all, it has been it's summer, and there's been a lot of volatility there, for summer, but you gotta also keep in mind that it is summer, and you got to be careful chasing the markets one direction or the other. The euro dollar has really proven a very technical beast as of right now, and I think it's very easy to read now. That doesn't mean that technical levels won't break, but you look at the euro dollar, and I know exactly why it stopped where it stopped yesterday, and I know exactly, looking at the euro dollar in here. Let me grab this dotted line. That's old.
Yeah, it was Monday when the euro was starting to recover. You said, I'll quote you, 116.20 is going to be resistance on any rally.
Yeah, and we went to 116.28. But it's just the underside of this triangle. Right. I mean, and you should be looking at the euro saying, okay, well, while it's below 116.30,
right?
Which, by the way, if you use ForexAnalytix, it's right here, right here, right?
Yeah.
While it's below 116.30. You stay on the short side, or you don't do anything with the euro. And if it breaks through 116.30, then based on what we just were looking at, that if it breaks above 116.30, it's going to be a breakout. And then you're looking at something like this, and I think that if you can just say, all right, if this then that in this market, then
I like that. Keep it simple. If this and that.
Right.
Beautiful.
Right. So today we have producer prices. People are expecting inflation to continue to show signs of life. And that may or may not be the case. But that will probably be, excuse me. Sorry, I didn't mean to yawn on you guys. It is 5.
It's too quiet in your house.
It's well, not at school yet. Everybody's safe. But it's still getting up at 3, and it is 5 o'clock in the morning here. So you know how it is. Since you're on the left coast, you never get a break. By the way,
you get a few months.
Being on the left coast, you never get a break. I get a 5-month break. When we shift back over to mountain time zones, but for you, I feel bad for you. But you live in California, so I don't feel that bad, because I wish I was that close to the beach. Anyway, that's another story. But like the euro is very well defined. One of the things that has really had me nervous about being short the euro dollar is the daily sentiment index that we have, and I'll pull it up really quick. The DSI, just so you guys can see it, this is pretty important to see. Dollar index is still, despite coming off of a 92 reading, we're at 82, which is still pretty, pretty high. And that's the one thing that's kept me from, shorting the euro dollar, when we're up here, because I know the dollar sentiment index is still pretty extreme. So I'm a little nervous. And frankly, I just haven't been trading the euro, even though I know it's well defined and I know I could just be scalping it. The euro gets up to, wait a second. Let me think. Did I short the euro yesterday? I don't know. I was thinking, I might have shorted the euro yesterday. At least I thought about shorting it. I don't know if I actually shorted it. What I am doing is I am long the cable, though. I bought the cable. One of the things that makes me feel decent about being long the cable from yesterday is that we did.
Good entry, buddy.
Well, okay, thank you. But hopefully, if you're like me, you didn't. Well, if you're like me, you kept your stops wider. I knew that the possibility of getting the major 618 retracement was pretty high, even last night. So we got to the 618. We hit a new trend low. So if you got to think about summer trading. I mean, this was pretty evident here, in my opinion. Yesterday, we dropped to a price, right? This is yesterday morning. We get to this, 128.50 change, I bought it at 65. So this is where I got long the cables at 65 yesterday, was my average. And we hit a, what in Asian trade, it looked like maybe a double bottom, right? So what is your immediate inclination when you test that low and you hold it? So let's think about last night before you went to bed, before I went to bed. How many people had adjusted their stops saying, okay, well, I'm just going to adjust my stops to below those lows, because if we break those lows, then, we're going lower. Well, in European trade, we broke those lows. We actually hit the 618 finally, and then reversed. Now, this false breakdown leads me to believe that we are going higher now. That doesn't mean we're going higher. I'm just saying that leads me to believe that this is the more likely outcome. We hit a new low, tripped the stops, hit the 618, and now we're going to go higher. But I need to, for me, the market needs to prove to me that that's what we're doing. So what does it mean by proving to me? Well, we've got to break above 129.20. We break above 129.20, and then I'll be convinced that, a near-term reversal is at hand. And you really can just, take it a step further and say, well, all right, let's just make sure, just for good keeping, let's make sure that we are breaking out. So this has to happen in order for the pound to really accelerate. And that means for me, in order for me to even think about adding to the pound long on this reversal, I need to start seeing a break above 129.20 for me to, add to it and think that it's actually going to be turning bullish near term. Yes.
Can I talk 1 second? Hi, good morning.
Wait, good morning. Oh, yeah, we had some comments, right, today?
Yes, I just wanted to say it was very good timing, because there's a piece talking that apparently the EU countries are preparing to offer a big concession to the UK. It's still not official, let's say, but it seems that some EU member states are reportedly willing to consider a deal where the UK, they actually remain in the single market for goods, and this is something that the EU negotiator Barnier had previously said, out of the question. But now it seems that some countries are beginning to consider this. Now, this brings us oddly brings us to a situation where the UK is going to be leaving the EU, but really staying in the EU in terms of how things are going to be working. Because apparently, in order to get such a deal done, the UK would have to replicate the current rules in terms of environment and social and customs and all that. So it's it's this situation where the UK wants to go, but it seems that everybody's working towards a solution where it's actually going to effectively stay. It's going to go, but the rules are going to stay. So, but anyway, the bottom line is the market took this as a positive. So,
well, yeah. I mean, yeah, and so that is what's really giving sorry, I'm just in the middle of putting in a pattern in place, so just give me 1 second.
That's fine. I'll actually say one more thing. Our friend Darren says that it won't pass Parliament. That's actually quite probable, but you never know what might happen. Things are fluid. There's a lot of negotiations happening. At some point, both sides have to kind of take a step back and give away something in order to gain something. So you're right, Darren. There's a good chance it won't pass Parliament. But as I've said before, a little step here, a little step there, we might massage things to bring them to a position where it's kind of acceptable on both sides.
And maybe that'll be the case. And, the pound, we can't deny the fact that the pound, I mean, it's lost almost 11% of its value since April. It's, obviously, relative strength is very divergent. We are oversold now. And I mean, we have just gotten pummeled. I don't know if this is the absolute bottom for the cable, but I am willing to play it for a bounce. Technically, how high will it get? Well, I'm hoping maybe the low 130s, maybe 132, 133. But I think the risk is now starting to really favor risk reward to be long. It doesn't mean it's going to work out, but I think we're getting to a point. Now let me ask you this, Stelios. If Theresa May, there's a confidence vote, and it looks like she's going to be replaced by another prime minister, what would happen with the cable? What do you think?
Well, the knee-jerk reaction should be negative.
Lower, right?
Because any kind of political uncertainty is not good. But the question is, what happens after that? Do you get somebody like Boris Johnson? Do you get somebody like Rees-Mogg? It's a lot of scenarios, but the knee-jerk reaction will be negative. I'm pretty sure about that. So,
okay, yeah, just and I'm thinking more longer term. Will it end up being more favorable for the pound with a new prime minister negotiating? But everything that has currently been worked on, a lot of it is at risk of being unwound. I guess that would be the immediate risk. So we'll see how the cable responds. But I do think that the cable technically, if we get above the 129.20, that's where we're going to be looking for longs. Now, Stelios, thanks for your comments. I just a couple other things I wanted to cover. The Kiwi just got absolutely battered following the RBNZ. They pushed out potential rate hikes all the way out to 2020. I mean, it was a really dovish meeting for the RBNZ, and that left the Aussie New Zealand right up at key resistance. We'd been talking all week. If you look at ForexAnalytix and you just go over to the Aussie New Zealand and read the analysis all week long. On basic technical analysis, you can see end of the week analysis, weekly charts, triangle break of the 110 level is starting to look likely for the pair with stops above the 110 level coming into view. And that was all the way into weekend analysis. And as we've broken higher, through the 110 level, we were looking at the pullback even yesterday. As long as we're above 109.75, it's bullish. And here we are, we are at now 111.50, and you have to start being a little bit more careful with the Aussie New Zealand. I'm not saying that it can't break. Frankly, I've been waiting for a break higher this for a long time. I've been waiting for this for a long time. But I've seen a lot of false starts. I actually got stuck long in the market right here and took a loss. I remember when it tried to break out previously last year, and I got stuck in this disaster. I lost some money right here. But eventually I do believe that the Aussie New Zealand is going higher, and this might be the catalyst because it's a central bank move. This might be the catalyst that actually pushes it above those levels, especially if the RBA takes a little bit more hawkish stance moving forward. I just have to say near term that if you're long the Aussie New Zealand, you do have to be careful here as we reach extremely overbought scenarios in the Aussie New Zealand. I had somebody ask me yesterday, should I buy the Kiwi? And I'm like, not unless, you know, it is broad-based US dollar weakness and you see the euro rallying, the pound rallying, the dollar yen rolling over. You know, those are the types of things that would provoke me to actually consider buying the Kiwi for a bounce. But, you know, the Kiwi ultimately, you know, we're below a multi-year trend line here, and we're breaking down. It does not look good for the New Zealand dollar, any which way you slice it. So I just wanted to point that out for those of you guys that have been trading the Kiwi, especially over the last couple of sessions here. And with that being, yeah, yes.
Good morning, mate.
Good morning.
Some North Korean headlines coming through as we speak.
North Korea says if Trump administration adheres to old scenarios, it cannot expect any progress on denuclearization. Wow, nice. Very nice. Hasn't done anything to risk appetite, except the dollar yen is sold off. The dollar yen sold off a little bit. Hey guys, I do need to pass it over to you because I'm going to be trading the producer prices, at least monitoring my positions. But good morning to you, Steve. And
good morning, mate.
And I hope you guys have. Let's see. I'm going to pass this over to you. And Stelios, thanks for chiming in about the cable. And Dale, have a great interview. I know it was a last minute change, so I hope it goes really well.
Thank you, Blake. Good hunting.
All right, great hunting, guys.
Thank you, Blake.
Good luck.
See you later, mate.
Bye-bye.
Great crew call yesterday, buddy.
Thank you, mate. Thank you. I'm going to talk about it, but
don't you love those immediate gratification?
Absolutely.
No heat from the minute.
Let's have a look at the data. We get data in a few seconds, and then we can talk about it. We have PPI and initial jobless claims.
Jobless claims are out already. They're more or less as expected. PPI is 0.0%, 0.2 expected.
Wow.
So that's actually weaker. Yeah. So that should be dollar negative. As you said, 213 versus 220. So initially
the metals are rallying on that weak number.
Yeah, let's have a look at it.
Actually, one little thing about the RBNZ before we move on, if that's okay.
Absolutely, I wanted to give you the opportunity to talk about that, Stelio, because I'm obviously going to show all the Kiwi pairs because we had a huge move following the RBNZ on all of them, obviously. So go ahead and say what they gave us.
Yeah, I mean, it's what Blake said already, that they pushed out any hikes for 2 years from now. But I think the more important thing and what the market got scared of is that they left the door wide open for cuts. And they actually quantified it. They said, Assistant Governor McDermott said that they expect growth to accelerate in the third quarter. And he said, and I quote, if it doesn't, it means that we've done something wrong and we're going to have to reconsider where we're at. Obviously hinting at cutting rates. So this is this is giving us a target for next quarter. And if the economy doesn't grow, you can expect them to start cutting. And remember, they are at 175. I think they're at 175 rates.
Yeah, 175.
So they have some space to cut compared to other economies. I mean, but it was very dovish, and I'm actually the Kiwi is down 1.5% today against majors. I'm actually surprised it's not down more.
Yeah, but, first of all, let me say that I'm willing to bet at least a little finger, a pinky finger or whatever, that nobody's hiking 2 years from now. End of story.
Yeah.
Nobody's hiking in 2 years from now. Mark this down. 2020, there is going to be 0 central banks that are going to be hiking.
Maybe Turkey when dollar Turkey is at 50.
Yeah. Okay. Yeah. You're absolutely right. with potential exception like that you just mentioned. Yeah. But anyhow, no major central bank is going to be hiking in 2020. I can put my signature on that. And you can take it to the bank. let's have a look, since you mentioned it. Let's have a look at what the Kiwi has done overnight. Obviously, we were looking for this triangle, and yesterday with Grega, we were reiterating that both of us were expecting a push lower from the triangle as long as 68.70 was holding. We got that, and if I zoom out, you need to consider here that not only we broke below the triangle, but we also broke below this descending trend line support. And as I was telling yesterday, Grega, my personal target is this nice confluence of supports at 65 cents. So I do think that the Kiwi is on its way there. Having to do now with the Kiwi yen, this is the formation I was watching, and we're now approaching support. Obviously, if we actually make it even below this support, it's going to be an extremely bearish development. Now let's have a look at cross rates that include the Kiwi. Cross rates like Euro Kiwi exploded higher. To be honest, that was not a surprise. I had made very clear that, in my opinion, between the cross rates, the Euro Kiwi was the one that was better positioned for a resumption to the upside. I mean, the move higher was clearly a very strong one, and the move that followed was very clearly a corrective one. Never managed to break below the 171 horizontal support area, and this consolidation was boxed within. You can see it as a bull flag. You can see it as a triangle. Regardless, any way you want to look at it, both of those are continuation formations. So, I had said that it can break either way, and whenever it does, it's going to produce follow through. But obviously, given the direction from which we entered this consolidation, a break to the upside was more likely. Obviously, this is threatening, a push to new highs. We had also talked about some days ago. I remember with certainty that it was within this week, but I didn't remember the exact day, that this was a triangle in the Aussie Kiwi, and I had like multiple confluences of resistance anywhere between 111.20 and 111.50. We actually sliced through there. We're currently pulling back in that area, so 3 areas of resistance very, very close to each other. And Blake already showed that a little bit higher than that, we find a much more important resistance because it's the resistance of this long-term symmetrical triangle. You can see that this triangle dates back to 2013. That's when it actually started forming. So, if we actually manage to break above this level and, for extra caution and confirmation, let's say above the 113 area, that's going to be a huge development. Now let's have a look at the pound Kiwi. Pound Kiwi obviously also exploded higher. Pound Kiwi, though, remains within a symmetrical triangle. So, between the Euro Kiwi and the Pound Kiwi, as I had said several days ago, Euro Kiwi was much better positioned. So big move in the Pound Kiwi as well. But, that actually doesn't help the pair break out from this recent formation. Let me put it here. Let me extend it here so you can see it better. So I would say that we still have to respect, the potential for more upside, especially in the Euro Kiwi. Now, these are not the only things that have actually moved, as Dale mentioned yesterday. Actually, just before I started talking on the webinar, I put on a pattern in play in crude, which actually moved immediately. I mean, just to give you an idea, I opened the position in my account and I started putting in the details in our system so the pattern in play could go out from the point I started until the point I actually pressed the button to execute, which is not even 30 seconds. The market had already moved 0.15%, and then the crude just completely collapsed. I've already taken half profits early today. The reason being is that we have a confluence of supports which we almost reached roughly at 66.10 to 66.30. The market actually made it there yesterday, very briefly. So I've already taken more than 3% of, on half of my position, but I'm holding the other half because this looks to me that it's probably going to produce some more follow through. And my next target is at 63.70. You can see here a horizontal support area down there, roughly 63.38, 60 to 64. So it's like a general area. I think, from what I saw yesterday, the market is actually going to make it there. Now, having to do, actually, Blake beat me, for just a few minutes, probably. I showed this on the chat room before. I do think that also the USD MXN is producing some nice reversal opportunity here. I was monitoring this descending wedge, seems to be breaking higher. I want to wait a little bit longer, but I'm considering trading this for a move towards this 1925 to 1930 area. I think this looks very nice for the time being, given the fact that it's beaten down quite a lot. I think that a nice reaction up there looks very likely. Gold is also attempting to make a move here. It's attempting to break above this descending wedge. We also see this RSI divergence. We know that both sentiment and positionings are quite extreme. So, a good possibility here to see some kind of a brutal reaction higher. Even if this proves to be just a corrective bounce, I think it can easily squeeze several dollars out of the market in quite a lot of time. Silver can also break higher, but I have to admit here, oppositely from gold, which produces that nice descending wedge, which is one of my favorite wedges. Ascending and descending wedges are some of my favorite formations to trade. Silver is showing a triangle here, and since very often triangles are continuation formations, I would actually, if I wanted to choose one to be long, I would go with gold. Although I know that silver has been overperforming the past few days, gold still, from a technical perspective, I prefer how gold looks. And, if I had to trade one of them, would be that. Now, copper, I saw the other day, this chart, I said that, this is the last opportunity it has to, rebound higher and produce one more leg to the upside before resuming lower. And, it might be doing that. Actually, in this case, I would be looking for resistance anywhere below 294. So I think that, copper can actually rebound higher, but I would be very, very skeptical. The closer we get to 294, the more skeptical I would be trying to actually buy it, because I think that eventually it's going to roll over and fulfill the double top target, which is down at 256. So, this is my view on copper as well. And let me also show, I think this is actually, platinum is probably I think has the most extreme positioning in history, having to do with COTs. And, the crowd is extremely short platinum. I showed it the other day. I see here a potential inverted head and shoulders formation. Let me show you. Here it is. It's not very pretty, but it is here. Right.
Steve, I remember, sorry to interrupt. I remember in gold, reading a couple of days back, I read somewhere that there's an all-time record speculative short positioning in gold.
Yes, the COT setup's very extreme and bullish.
Yeah. And keep in mind, Stelio, that I'm pretty sure that the positioning is even more extreme for platinum.
Steve, so, that looks like you. There's your eye and your nose and your other eye.
Yeah. Okay.
The nose is not big enough, Dale. It's not big enough.
Now you're going to actually force me to switch on the camera for people to see that my nose is absolutely fine.
Go ahead, man. Show that mug.
You want me to do that?
Yeah, because people believe Stelios because he's very sincere.
Okay, there you go.
All right.
Here's my nose.
All
it's
right.
fine, isn't it?
Yeah, it looks just like you. Good self-portrait.
Yeah.
No beard, but good self-portrait.
So no problem with my nose, right?
No,
Everybody
it's
can
good.
see this.
It's good. Just don't pick it on camera.
Okay, thank you. I'll take the advice into consideration. So yeah, I do think that platinum and gold look like they might actually be producing some kind of a move to the upside. I'm contemplating actually. I had a good rainfall having to do with my last 3 trades were quite nice and successful, and I had a very nice rainfall yesterday with crude. So, my fingers are a little bit itching. I'm going to get some exposure, like half of a position long in one of the metals rather soon, might even be today. I'll choose one of the two. I can tell you that in advance. And of course, I'm going to let people know in the chat room as always. I doubt I'm going to put the PIP on. I'm only going to do it if I decide to go full position. But if I end up just buying half of it, I'm not going to make a PIP. But I'm going to say it in the chat room. Anyhow, so that's what I'm seeing here, with metals and everything else. Now, having to do with indices, Dale, I can't add much more to what you said in your introduction. I 100% agree with what you said. Would I be selling here? No, I wouldn't, because even if we go to short-term time frames, let's have a look at this. This is the S&P in a short-term time frame, right? I was monitoring this as an ascending wedge. We got a nice ABC corrective move lower. Then we got another ascending wedge. But look at the price action that has followed. Does this look like to you something that's about to break lower? Doesn't to me. I mean, it looks to me like perhaps it wants to push towards the 161.8 of that corrective move before perhaps producing, more of, a bigger move lower. So I have to say that in the very short term, I would definitely not be buying, but I wouldn't be selling yet. Okay, which is more or less what you said. That's why I said I agree 100% with what you said in your introduction. Also, if we go back to the daily and we go to the NASDAQ, you'll remember that I was actually, viewing the NASDAQ as a potential ascending wedge from quite early when we were somewhere there. And, this tells me here that, sure, it might have more upside as well. I mean, I have a nice confluence of resistances roughly at 7,570, but I wouldn't even consider it improbable to, if we delay a little bit, to even make it to the 161.8 up there, to find again this ascending wedges resistance trend line. So I would really love to see this formation finally break to the downside. But, as long as we remain trapped within it, we have to respect the multi-year uptrend. As you stressed out, though, would I be buying to hold? Absolutely. Absolutely not. I mean, I already think that we are very, very high. We are very, very overbought. The market is completely ignoring factors that have proved over the years to be extremely important. So any way I look at it, I'm looking for opportunities to be short. I don't want to jump the gun, though, right? So until then, I'm just monitoring, and when I see something that actually stands out and makes me feel good, I'm actually going to do it. Now, having to do with the cable, I know that Blake already mentioned it. I know that he's long. I know that this is a tricky trade because obviously this pair has been beaten down. So keep in mind, Blake is a person. If you noticed before, and for those that don't know Blake, he said, "Did I actually buy euro yesterday?" That's not very surprising because Blake might actually make 10, 15 trades within a single day. So, it's not like me that I remember what kind of position I had yesterday because, I open positions like rather infrequently. I mean, I'm not a short-term trader. He might open and close positions multiple times. So if you want to belong here, there is a very good reason why you want to do this, because we actually tested triple confluence of supports. This was the 61.8 from the post-Brexit low. This was also the 161.8% extension of this move higher. This is also the descending channel support, right? So a very nice area. Let's see what kind of a candle we're going to get today, because so far we have a daily candle that's a hammer. But keep in mind that you need to be very nimble, and you need to make sure that you have the right parameters here. I mean, the right leverage you want to use. You know exactly where you're wrong. You're targeting. Obviously, the first target here should be 130. So let me make that very clear. The first resistance that the bear is going to find, if we assume that it's actually going to be indeed rebounding from here, is 130. So the first hurdle it has to clear is 130. And then this opens, the door for a move towards 133. And if that actually breaks, then we can be talking about 136. But it's very premature. I'm just, throwing out the levels I'm watching. But we have to take it, one step at a time. This is not something easy to talk about. I mean, looking for like 700 pips of an upside in such a beaten up pair, it's not something easy to happen. But as Stelios said, there are several factors that can come in play, which might actually catch the market completely wrong-footed, in which case the vast majority of the move that can ensue will be mostly due to people trying to cover their short positions to square off, right? So don't underestimate the power of a market that's already positioned too much one-sided to to simply move the market just by people trying to square off their positions. Now, I wanted to mention the Aussie. Obviously, the QE broke down, and one of the reasons, the main reason actually, was the RBNZ. Obviously, since the Aussie Kiwi is decently liquid, having seen that big move higher in the Aussie Kiwi, that has definitely helped the Aussie stay somewhat afloat. But despite that, we're seeing another rejection from this trend line resistance. So keep in mind that, in my opinion, the chances that the Aussie is going to follow lower, we were talking about that yesterday as well, but I've been talking about this almost daily, still remain very high. So if you're afraid that you lost the train having to do with the Kiwi, from a reward to risk perspective, Aussie looks quite appealing here. So, at least you haven't lost that one. Now, let me see what questions we have. I'll take it. Natural gas, absolutely. But let me go through. Okay, USD CAD. Let's have a look at it. I'll go through the populars, and I'll also have a look at natural gas. I won't forget. Okay, so USD CAD found support the other day at this 130 horizontal support area. Never actually managed to penetrate through this broken trend line resistance, which is a good thing, because this was part of what made these levels anywhere between 129.50 and 130 appealing, because we had the 50% fib, we had this trend line, we had this horizontal support area as well. So I have to say that also keep in mind that that was a perfect ABC. So despite having quite a bearish candle yesterday, which we had a very bullish candle the day before yesterday, because this was an outside white candle. Yesterday, on the other hand, we had like a quite a bearish candlestick, because we rallied higher, we found the 50 daily moving average, and then it reversed and produced this like long shooting star. But I have to respect the potential for more upside. I mean, we've already seen that the dollar is holding quite nicely. I told you that 129 to 130 is definitely a very solid support area for the USD CAD. So I think that as long as it remains above there, we do have to respect the potential for more upside. So I would definitely not be shorting here. I have no position anymore. I took profits on both of my halves at different levels. So, but regardless, my opinion remains that a chance of rebounding from here is quite high. Now, let me show the DXY. I briefly showed it yesterday before Gregor spoke. Okay, there are two alternatives here having to do with the DXY. In my opinion, both of them point to higher prices. One of them is a symmetrical triangle, which you can see here. If that's the interpretation, I would be expecting the DXY to resume higher quite immediately. The other one is a flat top triangle, so something like this. Okay, this looks like a continuation formation as well, though. So in both cases, I would expect that the chances of a resumption to the upside are very high. But if the flat top triangle is what we have here, we might spend a little bit more time, consolidating in here before actually making a move. Okay. So that's how I view this market. Aussie Swiss and Kiwi Swiss. Yeah, absolutely. Let's have a look at them. Okay. I think perhaps you were the one that asked them the other time. I remember a friend here had asked for the Aussie Swiss. Aussie Swiss, trapped within a symmetrical triangle. We are much closer to support. Let me say this. If we manage to get some risk off, I think that this triangle is going to emphatically break to the downside. But I do think that this trade would be helped immensely. I'm not saying that it can't break without a risk off scenario, right? But I'm saying that it will be helped a lot by seeing some risk off. And let me have a look at this. Kiwi Swiss. Kiwi Swiss, quite more bearish. This definitely has broken below a zone. There you go. Also, somebody could have viewed this. Doesn't really matter how you want to draw the line, like this, right? Any way you slice it, this is a bearish break for the Kiwi Swiss, right? Any way you want to look at it. So obviously, now where would I look for target here? Keep this. Next target 65.40, and you can see then the 61.8 at 63.50 looks an easily achievable target, at least to make it to that area. Okay. Natural gas. Let me remember. I should actually save it. I have to be honest, I don't trade it, but let me remember. What is it? Gas. Is this the ticker I was using? Nat gas USD. Yep, this is the one. Okay. Symmetrical triangle. So, I was saying that perhaps this was a pennant and we could break the downside. We hadn't seen that in a long time. That was not the case. So there's nothing much to add here because, as you see, we've been trapped in a symmetrical triangle since the end of 2016. So we're almost at the middle of it. So I think, we need to be patient. At a general note, though, I think that there is a good chance that there is one leg missing here. So if I had to take a position, I mean, if I was forced for some reason, I would bet higher, actually. A break higher might be the likeliest scenario, but I wouldn't be trading it here, right? I'm just saying, gun to my head, would I buy or sell? Probably buy. Aussie Kiwi, we already covered, but I'm going to show you briefly. I just said that I had confluence of resistances here, anywhere between 111.20 and 111.50. We actually sliced through those. So I actually said this is what I had drawn. I said that I was seeing this as a triangle which should break to the upside and make it to that confluence of resistances. That's exactly what happened. We're actually penetrating through them. So now I would be very careful. I would be very carefully watching this 112.20, because there is where we find these symmetrical triangles resistance. And I think that's a very critical level for the market. If this symmetrical triangle, which dates back to 2013, breaks to the upside, I think that there is a good chance that we're going to see a lot more upside. But be very careful, because the closer we get to that point, obviously, the reward to risk opportunity favors shorts. Okay. Dale?
Yes, sir.
I heard your chair creak, so I'm guessing it's interview time.
It is, buddy. We'll talk about Euro Pound tomorrow. Okay.
Absolutely. Absolutely.
Enjoy the interview. As I've said on Twitter, Steve, and I'm not being patronizing, you give one of the best daily technical reviews in the business. So thank you very much. And
it means a lot coming from you.
Thank you, bro. So Christopher Aaron, Chris, thank you so much for stepping up and coming to join our community today. And I'm now making you the presenter. Looking forward to hearing your voice, seeing your screen, and talking about hard money. Hi, Chris.
Hey, Dale. Thank you. Yes, can you hear me?
I can. Great to meet you, Chris. I saw you on Twitter. What really attracted me to you, you seem different than most gold advisors who live the mantra, don't wait to buy gold and wait. And when gold broke down, you showed it, and you talk about both sides of the market. So kudos to you. Before we get into the markets, Chris, I'd like to know, how did you get into the business as an advisor in markets, and why did you gravitate towards the precious metal industry?
Yeah, thanks, Dale, so much. So my background is a little bit different than most who you will find in the industry. I actually started my career as a civilian, quote unquote, a civilian working for the Department of Defense. And I was involved in mapping and reconnaissance and creating maps specifically for the military. I spent a year in Iraq and Afghanistan. And we were if you can imagine, so the job there is there's a lot of diverse information, a lot of complex information. And the job is really to create maps that boil things down in as clear terms as possible to get the necessary information in front of the decision makers. In the mid-2000s, I also started to see with my own eyes that the direction of the wars was not exactly what I anticipated going in there. And I began to study sound money and study some of the problems with fiat currency and how that was actually contributing to the war that I was there in. And I decided upon returning home that I wanted to do something and align myself with a cause that I believed in more long term. And the precious metals is one of those.
What a great story. Could I assume that you came to the conclusion that at times our country will get in war, get into wars to protect the hegemony of the U.S. dollar. And part of the reason that we may have gone into Iraq is Saddam no longer wanted to accept the dollars for oil payments and wanted other forms of payment.
Yes, I'm certainly open to ideas like that. And of course, it's a multifaceted type of situation. And I call them the wars because there's several wars going on and we're still there for all practical purposes. So there's certainly multiple causes going on. One of the themes that I gravitated toward was simply the amount of waste that I was seeing, endless tankers, tanker after tanker of, gasoline, oil, food being flown in from around the world, and then let alone the waste of tax dollars and of human life. So it's just something I gravitated toward, especially in the later part of my years. But just to bring it back toward the precious metals, there's this link between the precious metals and war, in that in times of high inflationary war, war being one of the most inflationary things that there is, the precious metals tend to respond. We see that going back. I don't know if you can see my screen here fairly clearly?
Yeah, we've got it, Bo. Yeah.
So you're showing a very
long-term chart, 74, gold's 1974 to 78.
Exactly. And we look at, think about this time period, the period following 10, 12 years of unsustainable conflict in the Vietnam War, and all that pressure builds up on the currency. And of course, that's when Nixon was forced to sever the link between gold and the dollar in 1971. And we can see what happens with these recovery attempts, let's call them attempts, from 74 through 78, the 50% decline and 100% recovery. And then when we zoom that out, keeping that y-axis on a linear scale, you can barely see the decline in the recovery when that pressure is built up there in the market. But I'm jumping ahead. It's just to say that I saw with my own eyes some of the need for precious metals, but I also see something else which I did not appreciate in this industry going back into 2008, especially the crash of 2008, which is that so many within this industry who saw the problems with fiat currency and with the banking system, they completely failed to recognize that precious metals, especially silver, and especially we want to look at the mining sector, that they could fall so severely in a short-term deflationary period as we saw there. And so I really gravitated toward technical analysis as just a way to, in a way, filter out some of the rhetoric, and let's see what's actually really happening on the charts themselves.
Okay, yeah. So, you're showing this period that was the prior bull market. We peaked on speaking about wars and history rhyming. The peak was when Russia invaded Afghanistan, and I believe the high was about 880, which marked like a 20-year top. So people went through a lot of pain after that peak in 1980. Silver was a Hunt's attempt to corner the silver market, and silver went to 50, and then we went through the Bataan death march all the way to the year 2000. So
that's
interesting,
exactly right.
Yeah. So I'm a little bit of a student of history too, and a lot of people don't even remember that bull market. What's interesting about that bull market, and you have a lot of people that are bearish. I know you're going to show current time periods is. Normally, a very important high like that was in 1980 at times can be retested. So, there are a lot of people calling for under 1,000 gold. 880 might be a potential target for this bear market to end later in the year. But go ahead. Let's just continue with your PowerPoint here. You're going to go to another time frame here.
Yeah, I agree with those statements that you made. Let me just show the backdrop of, so this was the bull market as you were just talking about, leading into that high. I think we're showing, some closing prices here. So the exact numbers will be slightly different. And so,
Right.
but when we look at, so this leads through 1980, price came all the way back down in 80, 81, and then we can see falling all the way back down below 300 here in 1985. And this chart now shows that same recovery pattern, that attempt at a recovery that we saw from the 80s through 1987. And if you think about what was happening here in the rest of the world, you know, the fall of 87, we had the crash in
Right.
the U.S. stock market.
Right.
Basically, the crash in the U.S. stock market, the crash of 87, corresponding almost exactly to the top of the recovery attempt here in gold. So gold climbed its way back toward 500. And think about this in percentage terms. This is a greater percentage move than we saw in 2016. You know, we saw about a 30% move there from 1045 up through 1370. This was a lesser, so this was a greater percentage move. But then I wanted to show the ramifications. What we can see here is that
wasn't that during that time period, the dollar was getting smashed, interest rates were heading up, which eventually led to the panic in stocks. And after the panic, okay, go ahead, buddy.
Yep. And so then, you know, we can see that when there's a market that's forming this, this is basically, if we were to take the right hand of this pattern here, this is something of an ascending recovery attempt forming this triangle shaped pattern. But you can see what happens. And I think sometimes the most simple forms of technical analysis are the most powerful. And we could see what happens when there is a failure of the market to hold a structure, you know, a structure to the recovery. Let's zoom this out a couple more years. There's that same pattern. Look, there was the failure of the recovery attempt, you know, 12 more years of declining prices. And I should say, it's not that the price collapsed, you know, from this failure of the recovery, let's call it 440. Okay, the gold market made a low around 250. In percentage terms from that 1980 high, a significant portion of the damage was already done by this point, but it's more a question of time. It's a question of, you know, hey, the market actually took almost 15 years to get back to that point after that. So let's just bring it into the present.
That was some type of opportunity cost if you were tied up in gold, maybe underwater when there were other things going. It almost took a generation, and the low was in, I believe, 2000, around 200. Isn't that correct? I mean, everything
correct,
before 9/11 we had bottomed. I remember there was some type of change in central bank policy that generated the first wave off that 200 low. I don't remember what.
Yeah, that's exactly right.
Do you? Young man?
They called that the Washington Accord.
Okay. Yeah. All right. Beautiful. Yeah.
And that was where the central banks, basically, it was just a statement that they made counting for this wave. Excuse me. No, it would have been the next wave, I believe. Right. But, you know, where they said, yes, we're going to continue to keep gold on our books as a reserve asset. Basically just a statement.
Yeah. Okay. Because back in 2000, people were saying, oh, it's an archaic relic. Yes, it makes a good paperweight. Don't drop it on your foot. Exactly. And that was the bottom. So you're showing a similar breakdown on your next slide that we had from this one.
So we've got to be careful here and think about what was happening, by the way, the entire time here in the late 80s through the 90s. Think about the macro backdrop. Now, the dollar was falling, especially from the late 80s through the mid 90s. So this is a point that I want to make because I'm actually bearish on the dollar at this point as well. But those two things are not mutually exclusive. You can have, and there are periods of many years where we see this in the markets, you can have a falling dollar and a falling gold price simultaneously. So that was seen, you know, here throughout the 90s. What else did we have happening here was the mania developing in the broad stock market. You know, especially,
the bottom in equities was August 1982.
Exactly. Yep.
At
And so, you know, this whole time we were starting to get that acceleration in the stock market, which is similar to what we're seeing today. It is, and there is inflation happening the entire time. Inflation is theft. It is the stealing of the purchasing power from mostly from the middle class who has some discretionary savings, and that purchasing power is being given to institutions, you know, the controlling institutions who are connected with the Fed. I do know these things. Most people in the precious metals community are aware of these things, but that doesn't stop. Just because there is inflation going on the whole time, that doesn't mean that gold has to rise every single year. So I just think we need to be careful about always having sort of set assumptions.
Okay. Agree.
So let's look at
you brought up that you could have a falling dollar and falling gold prices. You could also have a strong dollar and rising gold prices, can't you, Chris?
Absolutely. Yep.
Yeah, and that would fool more people, I think, than a weak. They're both kind of counterintuitive, but a strong dollar, I think, would really have people thinking, well, how could gold go up? Do you know what
I
period
think it very well could happen?
Okay, so but you're bearish the dollar here.
I am bearish the dollar here, and I will pull up. Let me pull up my dollar chart here for a moment. I've got it on another platform here.
Okay.
And I'm mostly bearish on the dollar based on looking at some of its constituents here. Let me pull up the euro.
Okay.
Euro USD long-term view. So what I like to do is start as long-term macro as possible. And here we are looking, just to give you my backdrop of where the dollar and the euro are. So here we're looking at the euro to the US dollar, and we're looking basically post freely traded era, all the way back to when the euro, we're talking about the constituents of the euro, mainly the German Deutschmark.
Right.
And what we're seeing here, of course, bringing it into the present at 115, what we can see is there are these clear 8-year cycles that tend to form. So from 85 through 1990, 1992, 1993, this up cycle, then an 8-year down cycle into 99, 2000, 2001, an 8-year rising cycle into 2009, and then an 8-year declining cycle here into 2015. So my analysis, and we can see what's happening here, this convergence. You know, look at this extremely long-term rising support line. It's
what a
right there,
huh? Isn't that amazing?
Incredible. Yep.
Yeah.
Yep. And I was
okay. So could the euro? So the euro uptrend really is okay unless we take out 105. So we could go 110, 107.5, and then begin to return back to the upside, and that would not disturb the uptrend. Okay.
Yep. And there's still about 3 years here left in this convergence. If we zoom this in on the last portion here, you know, we can see this could really extend out into 2020 a bit. These triangular shaped consolidations tend to resolve before the apex, you know, so we should be seeing a resolution here. We're going to know, is this a dollar bull market or a dollar bear market? We'll know this within the next 18 months or so.
Okay. All right. So why don't we get back to the present situation? And that was the chart I saw, and I said, you know, I got to have this guy on Face because he writes a gold letter and he's showing a breakdown and he's warning people to, you know, hedge or be careful about being long. So this is kind of a market analog to the one you showed, I think, from the early 80s. Do you think it's going to take 12 years like the previous example?
Now, I certainly hope not, because, you know, for my interest, and I am invested in the precious metals, and I do run a business helping people with the precious metals, you know, but some of that is tempering the outlandish enthusiasm that I do see sometimes in this sector. So, yeah, you know, just going back one more time, just so people can see, here's that 83 to 88. Look at the shape of the recovery. There's the failure. We see the result right there. And then let's look at where we are right now, this 2013 through present attempt. Now, is this going to take the same amount of time?
We could rally back to the breakdown before we head back down again. I only bring that up, not because it's, my view, although I think we could have, I'd like to see the big round number taken out at 1,200. But there is extreme positioning in the COT report, Commitment of Traders report. Do you follow that?
I do follow it, but I'll tell you what, I have never seen anyone consistently trade based off the COT alone.
Okay. Yeah, not alone. Yeah.
Yep. And I will say this too. I've also seen periods of time. There's a sense where the speculators
are always wrong.
There's this idea that the speculators have to be wrong, right? Always. Yeah. They can be right for many years in a row.
Yeah, and commercials could be wrong because they have deeper pockets than speculators.
Absolutely correct. Yep. So these people can be right for quite a while. So I always default to price. Price has certain patterns. What do we care ultimately about? It's price. I look at a lot of sort of secondary indicators. RSI, a momentum indicator. I look at some relative strength. Gold versus the various commodities. What's happening? But truly, what do we care about? It's price. And when we see a breakdown like this, I think we could have a rally coming up back to the breakdown point, sometimes even higher on a sloped trend line like this.
Yeah.
And we will know, every once in a while, a model can give us a false breakdown. Every system of analysis in the world has false signals that show up. So could this still manifest? Could gold recover this broken trend line and resume, a rounding out of the bottom and then an eventual bull market? It could, but look, it just has to show us. It's not some crazy figure here. We just need to see gold come back above 1260 or so and certainly stabilize in that 1300 region. And then I'd be willing to look and say, wow, it just gave us a royal fake out, so to speak. But until we see that, we should place the bias from this pattern in that the bottoming attempt is going to take a much more circumventous route than we hoped for originally.
Okay. All right. Do you have any views on the gold-silver ratio, which was starting to come in a bit a couple of months ago? And what is your view on silver? Similar to gold, more negative or more positive?
Yeah, I do have a view on the gold to silver ratio. It's something I follow quite closely. Let me pull up the chart here. And there's a bit more going on here. It'll be it's a few things that you will notice on this chart. But the big picture of it here is you can see in black this multi-decade resistance zone. Let's call it between 80 and 84. Let's round it off here. So 1, 2, 3, 4 major attempts here on this resistance zone. And then you can see when these trend lines have broken, these rising multi-year trend lines, it tends to result in significant and quick moves lower in favor of silver in the ratio. So we're back within one of these, these rising trends here. And there is a school of analysis that has said, and I've seen this posted a lot, that, hey, we're back in this zone. This zone has represented fairly important lows. When the gold to silver ratio is at a peak, it tends to represent lows in the sector because we're essentially seeing the speculative bid completely absent of the silver market when we're in these highs here. But I would just caution people again, don't take anything 100% for granted. The window, we'll zoom this in. The window here for this ratio to start breaking lower is in front of us. It's over the next 12 months or so.
Yeah.
Yep.
Back under that.
So we would want to see that.
Yeah.
Correct. correct. Coming back down, let's call it 76 or so. If we see that move, and certainly below this swing low at 75, if we start to see that here over the next 12 months or so, I think the sector has a very strong chance of recovering and perhaps negating that breakdown that we were looking at. But I would say if we're watching this and we continue to see this ratio, especially if it starts to exceed this 83, 84 level, I would just say, wow, that we're being shown something by the market which could be quite contrary to what a lot of people are expecting. In that silver, it would basically be telling us this: if we see this ratio remain here, it's telling us that the market as a sum is very comfortable with silver as a primary industrial metal for the foreseeable future. I do believe there will be a point that silver is re-recognized as a precious metal, but that could be some time off into the future.
Okay, so I see you also cover the miners, and they've been decimated. They were underperforming gold when gold was at 1360. Most of the miners were not even close to recent highs. They've been punished. What are you seeing there in the miners? And do you subscribe to what I was taught, that it's always more constructive when the miners are outperforming bullion than the other way around?
In general, I do believe that, except for it's actually ironic when we look at important turning points in the markets. The miners often get it wrong. They literally just get it wrong based on excessive enthusiasm in the sector. So what I usually do is I just compare, the miners on top to the price of gold or the GLD fund on the bottom. And let me just show you that example. So I look at it over various time frames. We continue to look at various time frames. Look at right here. For example, we're looking at the GDX on the top, and I have not updated all these charts here, but look at the GDX. Look at this little mini breakdown right at the beginning part of 2016, where it basically made a false, look at where we are here, January, a false little flush down below the previous lows here. This did not correspond with a new low in the price of gold. If you look where we were, the price of gold here in February 2016, it was already rounding up, and the miners made this final little flush.
Higher low in bullion, lower low in GDX. Great example.
Exactly. And so this, basically we have these false moves where sentiment in the sector just gets so lopsided that boom, then you have a 200% reversal. And basically anyone who sold into this signal just never had a chance, to get back into this sector. Of course, then what you said earlier, Dale, about the underperformance here, we can clearly see, look, gold getting back up to the highs, miners nowhere near, they're rounding over right now.
That's what kept me bearish gold. Yeah, that's what kept me bearish gold when we were 1360, was the underperformance of the miners. But what are you seeing here now, Chris?
Yeah, so when we look at this, we're still within this consolidation. We're fractionally under it right now. What's the print here for today? Opening at 2068 on the GDX. We were looking at a consolidation just below 21 through 25 and a half here. Let me change it over to this perspective, a little easier to see. Support and resistance. Okay. It looks like we're flirting with that level. It looks like the miners are getting ready to break down. So we could have a breakdown. Look, but here's the other point about the miners. The miners had come, when we look at the, all the way going back to 2011, the miners had fallen by 80%. That's 80%, over the course of 4.5 years. When a sector that cannot go to zero has fallen by 80%, there is something very interesting, from a value perspective.
Yeah. Buy when
I would just say
the street.
Yeah, it is. Yes, exactly.
I remember that. No one liked him down there.
Oh, I know, and there were all sorts of signals that there was at least a
Mux went from like 70 cents to $5. I mean, there were 4 bangers on a lot of shares, 4 or 5 bangers on that rally. That's why people love to trade them. You know, they're rainmakers at time. You know, they can refresh your financial landscape with a nice rain shower. So,
that's exactly
what a great interview, Chris. Really, anything you wanted to wrap it with, and also perhaps you want to show your website. I know that you have a newsletter, and that's your business model, correct?
Yeah, that would be great. Last chart that I do want to show really quick, and then I'll pull up the site, is this one. You know, just talking about the miners once again. This is one that'll really blow people away. We're looking at not the GDX right now. This is the XAU mining index. And the reason I'm looking at this one is because it goes back further in time. It goes back all the way to 1984. And when we look at the XAU relative to the S&P 500, which is the broader, let's call it so we're talking about the gold miners relative to the rest of the U.S. economy and the largest part of the U.S. economy. The levels that are, you know, including that 2016 rally, which was just right down here.
Yeah, it looks like a minor blip. Yeah.
Exactly. And when you know, this only goes back to 84, but I have brought up some of the constituent components of the XAU, you know, that go back, some of the Barrick and Newmont predecessors. This ratio actually, this ratio actually reached 1-to-1. And right now the ratio is at 0.02. So, you know, yes, over the short run, there's some bearish, you know, signs here that are coming in the sector. But when you have something like this cannot go to zero. A ratio between 2 segments of the U.S. economy cannot go to zero. And this is the lowest this has ever been. I would just tell you, you know, so this is why I launched the business, looking at ratios such as this. And that is what I focus on. And so our point right now with the website is, look, very few people were prepared for the rally in 2016. We are getting prepared now. So it's like, let's get prepared. Let's watch these things as they unfold, and we will get ready for that next rally when it arises. So we do cover, you know, there's flash alerts that go out. We do cover, everything. We do private placements as well, which are a more targeted form of analysis, of investments in the small junior sector. But they can check it out if they want, iGold Advisor. And just know that I take no funds from any of the companies or anything that I profile. I'm entirely subscriber supported. And that's the way that
you're not an investor relations guy, pumping stocks because you got restricted or free trading.
It's just not my model.
Yeah. Well, I love your model, and I think you're my go-to guy for gold analysis from now on, Chris. If you agree to it, you're my gold analyst that I'm going to go to as I see things unfold. Well, I encourage everyone to go check out Chris at www.igoldatvisor.com, and that's also his Twitter handle to follow him. And really appreciate you coming in. I'm glad that we were finally able to break the ice, and you taught me some things today. Great macro historical perspective that you have. So I appreciate.
Thank you so much, Dale.
I appreciate your time today, Chris. We all do.
It's great speaking with someone else who remembers some of these cycles and who's looked at them as well, because I really do think it's important to look at the lessons from history, as you said.
Okay. All right. Well, Chris, good hunting. And I appreciate your knowledge. How old are you? Let me ask you that. Do you mind answering?
38.
Okay. So you've got a lifetime ahead of many more cycles. And you have a great background in what you specialize in. So again,
thank you, sir.
Great presentation, Chris. Have a great day. And that's it for us today. Thank you, investing.com, for viewing this. Chris, you got on investing.com today. And remember, most of all, whatever's happening in the markets, don't just count your pips, count your blessings. Chris's Twitter handle is @iGoldAdvisor. Michael. All right, everyone. See everyone for wrap up on TGIF, and enjoy the rest of your day. Thanks again, Chris.